Hey, everybody. Before we dive into today's episode of the Agri Pitch, I want to invite you to check out our exclusive podcast, 19 Minutes. For just $30 a month, you'll have access to high-level business insights and new episodes that are released on the 9th, the 19th, and the 29th of each month. Topics include finance, cost of production, team health, taxes, collaboration, and much more. With 77 episodes already available, signing up gives you immediate access to all past and future content. Click on the link in the show notes and subscribe and start boosting your bottom line today. Welcome, everybody, to another episode of the AgView Pitch. We are heading into a new marketing week, and it is the first week of March, and so it's getting close to planting season. I mean, we're probably maybe 40 days away, and there's guys in the South already got the planters out and rolling, and so there's already, from what I'm hearing in the South, a little bit of corn going in the ground already. So with that said, today we have with us Jeff Fichtelman. Jeff, how's it going?
Thanks for having me, Chris.
Yeah, you cut out there for a second.
Can you hear me a little better now?
Yep, got you good. Got you good now. So, yeah, so no, it's good to have you on here again. It's been a little while since I've had a opportunity to talk with you, so I think we'll dive right into it here. I guess what I wanted to touch base with you on is first of all are the acres. It looks to me like, we were talking just for a minute on before we started recording here, just on kind of the cost of production difference between corn and soybeans, which we'll get into in a minute. But the whole acre thing. I was in Alabama this last week, and basically what I saw was pretty significant, I guess, opportunity for guys to switch out of cotton into corn. So I think there's other crops besides soybeans are going to shift to corn. And when I start looking at that in our client base, it looks to me like, I mean, I don't know, is 95 million enough, or is that, or is that still too lofty at this point yet? What's your thought?
In bit, I've probably, excuse me, underestimated how many corn acres there really could be. Yeah, we have a couple larger clients down in the Louisiana area that can grow rice, cotton, soybeans, and corn. And last year in 24, they were heavy rice and reasonably heavy cotton, but especially rice. Well, rice has fallen fairly dramatically year over year in terms of profitability, and all of those rice acres are going to corn. So they said they're going to increase their corn acres almost double versus last year. Now, there's still heavier soybeans down there because corn is tougher to grow, but yeah, it's like all of these little fringe areas. I love talking to seed dealers. We have a lot of our clients now are Pioneer seed dealers as well, and just try and get a gauge of like, what are you seeing year over year on your seed sales, which at this time of year, you could probably get a pretty good estimate. And I'm hearing anything from up 2% to up 6%, which again implies anywhere from 93 to 96 million. Some of the bigger seed companies are putting out their own estimates right now, which are, yeah, 94, 95 million. And I think the interesting thing, and you mentioned, Chris, like just briefly, we talked before we hit record of like, what's the profitability? And we try to get our guys to really understand their cost. But what I noticed this year, especially, is even guys who don't actually calculate their cost, they just intuitively know that they can make corn work at 460 to 480, and they can't make beans work at 1050. And that actually probably measures out with the guys who are getting in there and sharpening the pencil and really calculating their costs that beans don't work here and corn does. So as much as I want to be a corn bull, I am a little worried that these acres are maybe going to approach more than 95 million mark. Now you could still argue at 95 million, it's going to be tough the USDA is going to probably put in a 181 or 182 yield, but I would like to argue that it's going to be very difficult at that many acres, knowing so many of them are fringe areas, to plug in a record yield on record acres. So you strip down maybe to 176, and corn doesn't have as much of a story. It's going to be more difficult to see a five in front of corn at some point this summer, versus if we only get, say, 92 or 93 million. I think something with a five would be highly likely. So acres are a big deal. And obviously, spring weather is going to dictate a lot of it. But today, assuming a normal spring, probably are going to approach 94 and a half, 95.
Mm-hmm. Yeah, you were talking about the shift. what we've seen with our client base is about a 5.3%, to throw the number out there right now, shift to more corn acres, but we've seen a 6.3 or 4% shift away from soybeans too. So you kind of got to add those two numbers together. Now, they're not all going to, from soybeans to corn or corn to soy. I mean, there's other crops that are coming in here, like you said, that I think you go up in the Dakotas and stuff. There's some other options. I even have some people like, where they're in some of the lower production areas looking at just idling some acres too. And that's where sometimes people say, well, like, where did the acres go or where did they come from? Well, there's idle acres too, right? And I never really realized that until I started, getting in a little bit more spaces with Profit Manager. And as we get into more of these areas, it's pretty interesting how these acres actually do shift, a million this way or a million that way. And this year we might see 2 million this way or 2 million that way. It's going to be bigger shifts, I think.
Really good point I want to emphasize. And I feel like a lot of people are quick to say, I mean, me included, in the beginning, that we're going to have a ton of corn acres. But the one thing I was looking back in the last 20 years, the years where we saw huge corn acres, 94 and a half to 97, almost every time corn was wildly profitable and beans were profitable, but just less so. This is a unique moment because, as you kind of mentioned at the beginning, the average break even for guys on corn, if they truly throw in all their costs, is maybe in the 460, 470 range. And for beans, it's 1176. And clearly, beans at 1050 futures, you have to yield your way to profitability there, or maybe we'll get a gift and we could talk about what the lower bean acres mean in a second. But it's not like we're sitting here staring at huge profits for corn. A lot of guys, it's break even at best. If they could store it, maybe capture some carry, maybe you can pencil in $20 to $40 an acre profit above the return on management. So, I mean, it's going to be interesting this year, to your point. I mean, talk about, like, why wouldn't you look at some of the other options out there? I mean, yeah, idling, there's other crops that maybe cost less that they're going to try out. There's obviously more growing interest in premium crops, solar panels. I mean, that could be an interesting alternative. And yeah, all of those individually are small, but they could add up to a two crop corn and bean total being less than the market expected. So
Hmm.
it's going to be an interesting one for
Yeah.
sure.
Yeah.
March 31st is highly anticipated.
Oh yeah. That's probably going to be a pretty big mover one way or the other, isn't it? I mean, kind of a big time mover
Yeah.
this go around as usual. I mean,
Yeah. The one thing I would say on the March 31st report, my experience trading these markets is almost every time it's a big market mover, it's actually the best way to trade it is to fade whatever that report tells us because it's early enough in the year. So, for example, if they put a really low acreage number for corn and corn shoots up to the high fours or low fives, that's a really great selling opportunity because it's still at a time of year where guys can shift some acres. So if they put a say 92 million acre out there, market gets all amped up and bullish, farmers can still suddenly shift and sell corn and plant it. Whereas if they put a big bearish number, it's still time for guys to say, man, if corn goes back down to 430, 440, I just can't make that work. I'm going to look for alternatives, especially if let's say they put 95 million corn acres and say 81 or 80 million bean acres, something crazy low. I mean, and suddenly beans shoot higher. So it's always been an interesting report from the timing perspective because so many in the Midwest can still make small adjustments based on the outcome of that report. So as a farmer, the best thing is if we get a big bullish report on corn or beans, you probably need to take advantage and sell something against that.
well, yeah, if you're going to shift these acres, I think for sure. And the other thing I would say to add to your comment there is um, that I think still supports corn, even if corn goes down some, is the insurance level versus soybeans
Hmm.
too. So there's a guarantee there. And then I know a lot of people are looking at ECO this year, and if you're not, you need to be because that's another insurance level leg up between that 86 and 80 or 95%. You can buy that anywhere from 0 to obviously to 100% anywhere incrementally in between there. And I think that's going to be something that when people look at, okay, well, I can take that corn up to 95%, and I've got, the floor in that 470 range on corn versus soybeans, which I'm not exactly sure. I didn't see exactly where that one ended, but it's a long ways off. I mean, the price ratio is way too far off, and so I think it's still gonna, lean towards the corn. I think there's some operations out there that are super tight on working capital and on cash, and I think there's banks putting pressure. But I'm hoping that the bankers, and if there's any bankers listening, I mean, guys are going to make more money planting corn, and there's going to be less risk because you can insure for it. So I think extending some lines of credit, even if they're already full, and if you want to take less risk, I think you got to let these guys plant corn, and we're gonna then ultimately, the question I have for you then is how much pressure, if we do see a 95 plus, and the weather is good, how much pressure potentially do you think that puts on things? Because that's where the insurance really going to stick in. If we have a fall price in that, you know, 370 range, all of a sudden you just took the spring price and dropped another dollar off of it. That puts a ton of people, in a pretty good economic position at that point. Not that you want to make money on
Yeah.
insurance, saying the what it's protecting.
Yeah, you're right. I mean, let's just say they print 95 on March 31st and we actually get the acres in. So we have a clear spring for most part. And then the market then starts to build in, okay, what we said on March 31st is going to be a real number. The first time the USDA will put that into an S&D table is the May 10th or 12th. I don't remember the exact day, but the May USDA report. And the USDA, regardless of, you can argue 181 or 182 yields not realistic, they're going to put it in there. They always do. They start with trendline yield, which actually is 183 this year. So I'm being generous to say they might only put in 181 or 182. No matter how you slice it with strong demand, 95 million acres and a 180 plus yield is going to print a 2 billion bushel carryout. And all of these big spec funds who are now long about 250,000 contracts of corn are going to have a really hard time staying long. Now, the USDA, what they almost always do is in May, they'll print that, and come June, they almost never make a change unless it is like shockingly bad weather where maybe they feel like, hey, I either have to reduce acres or reduce yield. Odds are likely, assuming somewhat normal weather, the May, the June, and even the July S&D statement will probably print 2 billion bushels all the way through. So it's going to be a lot of headwind for markets to rally in the face of printed large carryouts, which means, in my opinion, it might take time for corn to rally, and it'll again have to be based on strong demand. So if we print 95 million, I think diesel will probably trade back into 410 to 430 range. But to your point, I mean, when you think about the Feb average around 470, 95% of that's 445. So I'm a huge fan of ECO. I mean, every one of our farmers has signed up for ECO for corn and beans. It's the cheapest way to get a 95% floor. The only drawback from a cash flow perspective is it doesn't get paid until like June of 26.
Mm-hmm.
So while it is true, like payment potential, there's a floor effectively in place. Obviously, there's a little bit of the unknown what county yields are going to be. The cash flow perspective, it takes time. And a lot of our guys are reducing their underlying coverage down to 80, 75, or even 70% just because they want to save money. And that's kind of the trade off, which means the underlying policy that if you do have any kind of hiccup, won't pay anything or very little. So, I mean, we're putting all our eggs in the ECO basket, which I think is fine because that's the smartest money to spend,
Mm-hmm.
but it does force more discipline on the marketing side. So I think if we print 95, we're going to be in a summer lull and maybe a late season rally, um, barring any kind of weather story, because we're going to have super healthy demand if we're down in the 420s again. It's not the worst thing. It just takes time then. And if we print a big bullish number like 91, 92 million corn acres, I think it'll actually be more short-lived. I think what will happen is we'll rally, guys will maybe switch more to corn, and demand will start to slow. So I think we have to be quick to sell a March 31st rally if we get one.
Mm-hmm. Yeah, that's a good thought. I do want to comment on the insurance. I mean, and this isn't advice, but boy, I'll tell you, when we look at the threat of removing those lower levels, so that RP, that standard RP plan for, I'll just use corn as an example, and I'll use some kind of average numbers, but I would encourage people to go in and look at what your cost per bushel is for those. Don't be thinking in terms of cost per acre, be thinking in terms of cost per bushel. Take your APH, divide that by your 75, your 80, your 85, whatever you've been doing. I would caution people to cut that back and not spend the extra 7 or 9 cents. I mean, ECO is between somewhere, if you take most people's APH is somewhere between about 7 and 9 cents a bushel. If you have a really low APH, it's going to be obviously a little bit more. But if you look at it from that perspective and look at the value that brings with a 65%, and I don't sell insurance. I'm just saying here from a risk mitigation standpoint, man, a person's really gotta this year has to look at the threat that's there. And then the other thing I think that people need to really take a really close look at is what is their burn rate on their working capital? Are they in a position where, you know, they got, if they have another two more shitty years, all of a sudden it's not going to be good, and so you got to really protect that working capital. And that's one of the key ways of doing it. I mean, obviously they got to get their cost of production dialed in to the penny, talk to somebody like you and say, okay, here's my numbers. Help me with the marketing side. Help me get these things dialed in so that I can have a margin. Where should my margin target be? Here's what I'm thinking, and get some other perspective, and then make sure that plan is in play, and then stay disciplined to it. And I think when people try to save money on anything that either enhances or protects yield is pretty dangerous, in this kind of environment, so I don't know. I just had to throw that out there because it's my soapbox of risk mitigation on a year like this in particular. And and I guess the other thing I wanted to hit with you was, just from a practical standpoint on the marketing side, whether it's corn, soybeans, wheat, whatever, what are some practical things that, as we go into spring, obviously we're watching the funds, we're watching energy prices, all the commodity prices, we're watching Doge, we're watching the general economy, we're watching, geopolitical stuff. What are one or two key things that we need to be watching from a practical standpoint? I mean, that's all the noise and all the stuff that's going on, but from a practical standpoint, if you're giving, your clients advice, what are you telling them to be doing here in the next month or 40 days before the planters roll?
Yeah, the geopolitics side, I would say in the last 20 years has played a very small part other than Trade War 1.0 back in 18. Well, this year in 25, I think it's the market's probably going to over exaggerate the true impact in terms of lost demand on, say, tariffs to Mexico. However, that's what markets do. They over exaggerate realities and create huge swings. And because I think Trump, one, he has a directive to reduce government spend, and part of that could feed into some of our private programs, FSA programs. So we have to be mindful that we can't necessarily take a program payment as it's coming no matter what. Everything is now suddenly up in the air. But at the same time, he's obviously very pro tariffs. But what I've noticed the nuance with Trump is he's also reactionary to markets. So, like recently, this Mexico tariff, obviously, what almost he said he's going to tariff Mexico, Canada. Saw maybe the initial market reaction, Mexico, and to an extent Canada, but definitely Mexico. They made some concessions. They said, "Hey, we'll put more troops at the border. We'll work with you on drug flow and immigrants and all that." Trump felt good about the kind of semi-political victory. Said, "Okay, good. We'll quote delay it." Well, of course, early this week, he said, "Hey, now it's going to turn on early March." And just yesterday, I think he said maybe we're going to kick it back to April. So, I mean, the guy, I appreciate what he's doing, but man, he's going to create a ton of volatility. So, from a farmer perspective, I think the single best way to do it is if you get a rally based on geopolitics, almost no matter what, close your eyes and sell something. Because what's likely going to happen is we're going to have ups and downs all year based on the ebbs and flows of this. I think Trump wants to put these policies in place, but he also understands he doesn't want to send the general economy into a major recession, and he doesn't necessarily want to send commodity prices all over the place because it could be both inflationary and hurt farmer bottom lines. And I don't know how you balance all that. Um, to put through his plans, that means there's going to be pain in the general economy, but to do so without impacting markets is impossible. So I think what's going to happen, he's going to get these back and forth. And instead of trying to follow it and outguess what's going to happen, I think you just have to say if it's a bullish geopolitical reason, sell something. If it's bearish, you just have to make a judgment call of like, is this truly permanent? But I would guess most of these are not. They're going to come and go, react on the downside. Buckle up. It's going to be a roller coaster this year because
Yeah.
of that.
Well, and we saw the February rally, which is kind of interesting. I mean, kind of counter seasonal. Typically during that price discovery period, it stays flat or goes lower. And then I think, that created a lot of optimism. And then there was probably, I know some of our clients were making sales, but then when we turned back the other way, everybody wishes they would have done a little bit more than they did. But what happens when the price goes up is everybody gets all bulled up and, oh, well, this could go a little bit more. And then all of a sudden it's done. And to your point, I think that's a great practical perspective. And just getting those targets in. I mean, that that helped so many people that I watched, during the month of February. And there were some people that wish they wouldn't have started selling where they did when we went to where we went to. But on the same token, now we're back to where we were. And so, you got to look at your average price. You still got to have a margin target because nobody knows where the stupid market's going to go in the first place anyway. And if you know your costs and you can get that stuff dialed in, I think that's really key. Is there anything else that guys should be watching, on the excuse me, on any of the other fronts as we kind of wrap things up here? Just anything that you want to kind of leave the producers with in the chat here?
I do think we're going to be in a year of ups and downs. It's not going to be straight up then straight down. I think we're going to have more of the up and down roller coaster. So we just have to keep maintaining discipline. Let's not let ourselves get super bowled up when it rallies, but rather close our eyes and sell something, 10%, whatever, and just keep doing it ratably over the next 16 months. And then honestly, the best way out of this is yielding our way out.
Mm-hmm.
So let's not lose sight of that and do everything we can to try and maximize our potential good yields. Obviously, it's crop insurance season, so let's be smart. Talk to your agent about ways to maximize it. Huge fan of ECO just from the low cost coverage, but it's going to be another year of low margins, difficult setup. So let's be smart, not get ourselves in trouble. But
Mm-hmm. At the risk of offending any insurance agents, I'm going to say this, but I did a talk yesterday for BASF on just kind of where cost of production's at and just being profitable. And one of the things that I get your take on this, but one of the things I said is, we all have helpers, right? We have our brokers, we have our lenders, we have our insurance agents, we have you know, uh, our attorneys, our CPAs, our other helpers, and stuff. I always tell people, write down the names of all of your helpers and then score them from 1 to 10. And if you give them anything less than an 8, they should be fired and you should be finding somebody else, and we're in that insurance time frame as we record this right now. And I think, with all love and respect to all the agents out there, a lot of them are really good and I think are trying to do the right thing. But I think, we really got to make sure they're asking the right questions. I mean, you guys have to do that on the brokerage side. There's a lot of questions and a lot of things you dig into to understand their cost production and their threats and what you guys, and I know you guys do a really good job of that, understanding their business before you're trying to help them figure out where that margin and those opportunities are. And I think that's the thing that we have to expect from our insurance agents too. If they're not doing that, you still have 15 days yet to find somebody that does understand your situation and can help you. My advice is go help yourself. You gotta take care of yourself. But anyway, again, last word for you, and then we'll wrap it up.
no, I mean, you're exactly right. If you have an agent that just says we're going to do the same thing like we did last year and every other year, that's not a good agent to have. This is a puzzle. We didn't even talk about our county being a great policy as well. That
Right.
shifts things. There's base acre impact, stuff like that. So challenge the people that help you, that you pay for. I think that's exactly right. So
Awesome. Well, hey
I
Jeff,
appreciate it.
it's been a great conversation again, and we'll definitely get you back here. We get into the month of March a little ways and get closer to planning season here, and we'll all be a little bit smarter after the March report here at the end of the month too. So, with that said, thanks a lot.
Thank you.
Yep, you bet. All right. Hey, everybody. Thanks a lot. And again, you probably heard the advertisement at the beginning of the discussion here on 19 minutes. Make sure you check that out. I think there's close to 80 episodes in 19 minutes there now. Get signed up. Pretty easy. There'll be a link in the show notes here to sign up. Good time to do it when you get ready to be in the field here. So lots of opportunities to grow your business. With that said, thanks everybody. Catch you next time on the Agri Pitch.